Hello, everyone. Welcome to a Wall Street from Main Street podcast special. My name is Mo Desert, and today's special guest is Robert Wenzel. He is the editor and publisher of the Economic Policy Journal. Thank you, Bob, for being here.
Hey, Mo. Pleasure to be with you.
Okay, great. Well, one of the main events that happened in the U.S. economy is the Detroit bankruptcy. So I want to get your thoughts on what's going on with Detroit and why it's becoming a bankrupt city. And I also wanted to ask you, do you think Detroit is a good example of what happened when you have capital inefficiency and too much government intervention? Because, Michigan is a, liberal state and mostly full of Democrats, despite what MSNBC is saying that, Detroit is a libertarian city and you could blame all the problems on libertarian and Republican.
Yeah, Mo, I'll tell you what really starts it is, simple math. I don't think the left understands basic math, because what you have, anytime you have a situation where you're spending a lot more than you're taking in, you're going to have a problem. And that's been a problem with Detroit that just got bigger and bigger. And there's enormous amount of money that has to be put into pensions that different government employees got when they were working. And so basically, that's what you have, a tax and spend government where actually the tax base was decreasing because people were fed up with the city and were leaving the city because of the poor services. And consequently, you have a situation now where the city owes billions and they can't pay it.
Yeah, Detroit owes $18 billion in debt. $3 billion in unfunded liabilities. And one of the major problems I found out about Detroit is the government workers in the city of Detroit are making more than the taxpayers. And that's a big problem because, as you know, government workers, they don't produce anything. So they don't produce any capital, which, when you produce something and create capital, that creates more jobs. And that's one of the problems that Detroit is having, is that there's not many entrepreneurs and productive citizens out there that's creating capital, and therefore there's no jobs.
Right, and what you're really talking about is a situation where Detroit is really a microcosm of what's going on in other cities here in the United States, and also at the federal level. You have the government sector is growing, and you have employees going into situations where it's not productive. It doesn't necessarily mean people can't find jobs outside the government sector, those people that aren't working for the government sector, but because so much money is drained into the government sector, the amount of money left on the sidelines for the private sector is less, so there's less bidding up of the prices and the hourly wages, and it's particularly a problem for the unskilled labor, because if they're truly unskilled and the government is increasing the minimum wage law to a point where it doesn't make sense for businesses to hire these people, you get more unemployment, more people on the dole, and more of a collapsing situation. And again, Detroit is just a microcosm. We talked before going on the air. Other cities are in the same situation. States are in the same situation. Illinois has a very serious problem in addition to the city of Chicago itself. And you're going to start to see this develop over years. It's not going to all happen right away, but over the next few years, a couple of years, between 2 and 5 years, depending upon the city or the state, you'll see much more problems develop. And it may even go into the federal sector, because the federal sector is really pretty much in the same boat. And if interest rates start to increase the way I expect, that means the Treasury is going to have to start borrowing more and more money, which means the Federal Reserve is either going to have to buy that by printing more money, which will be inflationary, or they won't do that, and interest rates will go through the roof. So we've got a lot of problems developing in the financial sector through government, public financial sector throughout the United States.
And right, and you brought an interesting point of how this could spread out to other countries. We have cities like Los Angeles, Oakland, Baltimore, Chicago that, in the same boat as Detroit. They spend more than what they have, and it could possibly go bankrupt as well. And I asked you this question before we did the podcast, and we discussed the possibility of the Federal Reserve stepping in and start bailing out these cities. I wanted you to share your thoughts about that to our listeners.
Yeah, sure.
Do you think,
sure. Yeah, it's basically a situation where it really depends. I mean, we talked specifically about Chicago and how there's more union pressure there, so there may be more pressure on the federal government in Obama to bail out Chicago than some of the other cities. But then there are just the real economic factors which may prevent it, and that again is the fact that interest rates are starting to climb now, and I expect them to climb much, much higher. And this will require the Treasury to buy, to issue more and more bonds to pay the interest, and that will sort of put additional pressure on interest rates to go higher. So the Fed may come in at that point and start buying up these treasuries to prop up the Treasury market. And if they do that, then the question becomes, how much more money are they willing to print to bail out different cities, because it will be very expensive in terms of price inflation. I expect price inflation to increase substantially just from the Treasury buying, never mind if they try to prop up any cities or states. So the cities and states may fall by the wayside. That said, the one thing that might save some of these cities and states, particularly ones where they're a few more years out before they face having to deal with the situation, if there's enough Fed printing where the inflation is severe, they may be able to just pay off this debt in very, very cheap money, which will not be fun for the rest of us who are getting paid in depreciating dollars, but it may be an advantage to some of the cities and states that are in debt.
Right. So my last question, well, I actually have two more questions regarding Detroit. Is I know you're not a politician, but from an economic point of view, how can Detroit become a viable city it once was in the past?
Well, that's pretty easy. Just get government out of the way. There's some talk that because the government is so restricted now because of the financial situation, that there's a lot more freedom cropping up and regulations aren't enforced on entrepreneurs. And if that's the case, then the city will actually grow and prosper. I mean, they've got to lower the tax base, cut taxes, cut regulations, and just allow entrepreneurs to find where the pockets of potential are in Detroit. Every city everywhere on the planet has potential as long as it's allowed to grow, as long as there's freedom for entrepreneurs to search out where those opportunities are. If you look at the poorest parts of the world, it's usually a situation where it's a very, very powerful government that doesn't allow private property, doesn't respect the rule of law, and the people caught up in that just have no opportunity to create and keep what they create. So it doesn't happen. And in Detroit, if because of this financial collapse, because of the problems with the public sector, if that sort of mutes the public sector, makes it a lot less able to put restrictions on entrepreneurs, that's where we might have some opportunity.
And my last question about Detroit is, do you think the fall of Detroit is a victory for the liberty or libertarian movement? Because Detroit is like a showcase to show people that what happens when you have too much government, too much regulation, and high taxes. This is what happened. Do you believe this is a victory?
Well, what happened in Detroit is certainly something that libertarians expected. The problem really comes in is that some people see what happened in Detroit is a situation where there's not enough regulation and not enough government intervention, and so it's a victory for libertarianism in the sense that, hey, we say these kind of government situations can't survive and they will crash, and that's what's happened in Detroit, and that will happen in other countries. Other cities and states, but the problem becomes one of what the people will really understand as the true cause and what they will want as far as solutions. Some people may actually want the Federal Reserve to print even more money. I mean, there's different economic thinkers out there now. I'm thinking specifically of modern monetary theory, and those people are in favor of just printing money like crazy. So yes, it's a perfect example of what libertarians have warned about, but I'm fearful that the message just won't get across to the masses, and you never know what you're going to get from the masses, and who arises from the ashes and promotes different types of solutions that may be worse than the problem itself.
And we'll have to see if Detroit will be the start of a domino effect that will go on in this country regarding cities filing for bankruptcy and collapsing. So I want to shift gears here and talk about Austrian economics, which is related to free market economics. A lot of mainstream and Wall Street media, economists, politicians bash Austrian economics for promoting free market capitalism, which is quote unquote called the Great Depression or the dot-com bubble or the housing bubble, which is, you and I know it's not entirely true. So why do you think Wall Street hate Austrian economics?
Yeah, well, there's a couple of answers to that. The first one is, first of all, Austrian economics itself is a non-judgmental science. It does not in itself make prescriptions as to what method should be taken. That comes from an ethical perspective, and why most libertarians tend to be Austrians is because the Austrians also explain how what the best methods are to achieve things. But Austrian economics is a science which has to be separated from ethical policy prescriptions. On my website, economicpolicyjournal.com, I have a post up of a video made by Tom Woods where he discusses this in detail. It's very important to understand. But that being said, what goes on Wall Street? There's two or three different groups that you have to. It's not everybody sort of out of the same fishbowl in Wall Street. You've got the guys that are clearly in bed with government, the crony capitalists, the crony banksters. That would be Goldman Sachs, Morgan Stanley, J.P. Morgan, people like that. And they don't want to hear anything about Austrian economics because the prescriptions that would lead from an Austrian perspective would be to end the bailouts of Goldman Sachs and Morgan Stanley and those type organizations, and quit the manipulation of the money supply and interest rates that the Federal Reserve does for the benefit of the crony capitalists. And these guys are all, they get really on the inside. There's something called primary brokers, and there's just a limited number of them, and of course Goldman Sachs and these guys are all in that group. So those guys don't want it for that reason. Then you have another group which consists of mainstream trained economists that really just don't understand Austrian economics at all and how it explains the economy. And so they have these poor models of the economy, and they don't understand that there's a better model. I gave a speech about a year ago at the New York Federal Reserve, and after my speech, I had a discussion with a couple of the economists, and what was remarkable is when we were discussing Austrian economics, and these are mainstream Keynesian guys. One of the senior economists said to me, he said, I know about you guys. You're the ones that have that equation PV equals MT, which really shocked me and really provided insight into how isolated these guys are. Because not only is PV equals MT non-Austrian, it's really something that comes out of the Chicago school. It told me that this senior economist at the Federal Reserve didn't understand Chicago school economics, which is Milton Friedman and fairly well known, or Austrian economics. They're just in that tunnel of Keynesian stuff, and they don't know anything else, which is completely different from somebody out of the Austrian school who will not only understand Austrian economics, but know Chicago school economics, know what's good and bad about Chicago school economics. And the same thing about Keynesian. We understand Keynesian theory. We know what their liquidity preference theory is all about. We know what their aggregations are all about, and it's something that the Keynesians don't do in reverse. They don't understand our stuff at all. So that's another group of people within Wall Street that are sort of anti-Austrian, even though they don't even know what Austrian economics is. Then you have a third group of investors who are just really out there to make money by trading the markets and investments. And some of those guys have a curiosity about Austrian economics because they want to make money. So they want to really understand what economics is about. They don't really want to just take the political position on it, whatever's being shoved down people's throats. I mean, they really look for information. And the best proof of that is I have a daily alert newsletter called the EPJ Daily Alert. And you'd be surprised at the powerful people within the investment community that subscribe to the letter. Of course, I can't go into names, but these are people you'll see every day on CNBC or in the headlines and things like that. And they're out there subscribing to my very pro-Austrian perspective on how the economy works. So the area that gets the best attention from Wall Street are the people that are really serious about making money. And in the middle, you've got those mainstream guys that are really just clueless. And then you have the cronies that are in bed with government and are just interested in protecting that special relationship they have with government and don't look at Austrian economics for that reason.
Right. One of the things I like about Austrian economic is it's simple. It doesn't use any mathematical model, economic model to try to explain to people why this happened, why the housing bubble happened. They can explain it in simple terms so people can understand, and without even using any equation or formula. It's compared to the mainstream economic view that you see out there today, where they flash a lot of models in your face and try to explain it so you don't have to understand it. So that's one of the things I like about Austrian economics.
Yeah, basically that's a very important point. The methodology of Austrian economics is different from the mainstream, and the way to understand it best is that what mainstream economists try and do is they try and look at empirical data and try and form economic laws by the empirical data they find. And you really can't do that in the social sciences as Hayek and Ludwig von Mises pointed out to us. What you really have is a situation where, because we're involved with human action when we're looking at economics and other social sciences, there are no constants the way there are in the physical sciences. In physical sciences, you have water that freezes at 32 degrees. You put 1 gallon of fuel into a rocket, and you know exactly how far that rocket's going to fly. Well, there are no constants like that because it's in economics, because it's dealing with people, and they can change their minds tomorrow. The price of a potato might be the same for 10 years, but that doesn't mean it's going to be the same for the next year. So there's a faultiness in the methodology that the mainstream guys use, and that's why they really get into the big mistakes. When long-term capital blew up, which was saved by the Federal Reserve, they were trading based on certain parameters of where Russian bonds would trade and South American bonds and all that. And of course, when things broke out of those parameters, they blew up. Well, that doesn't come as any surprise to an Austrian, because there just aren't those constants, those parameters. The mathematicians, econometricians, what they try to do is they try to force something to be a constant that isn't. And what I say is, that's really fine until those variables start dancing. They may be constant for a long time, but when they start dancing, they do a lot of damage. That's what happened with long-term capital management. That's also what happened with the subprime mortgage market. There were assumptions as to what the default rates would be, and as soon as those default rates skyrocketed way above what the assumed levels were, all those blew up. So that's the problem with that kind of thing. What Austrians do in their methodology is more along deductions. What they do is their analysis of how the economy works, the theories they develop, are along the lines of geometry, algebra, calculus. There, where you start with a basic premise. In the case of economics, it's man acts, and I recommend there's an incredible book by Ludwig von Mises, it's Human Action. It's not the easiest book to get through, but he starts out with the basic premise that man acts, and from that deduces all of economics: minimum wage laws, price theory, interest rate theory, the business cycle. All of that comes out of that one premise. And so, because it's logical, and unless there's errors in the logic, it's logically consistent, we're able to understand things in all periods, not only for a period where Russian interest rates or Russian bonds stay within a certain parameter, or default rates fall within a parameter in subprime mortgages. We understand things that apply for all times with the theoretical background. Now, that doesn't mean that because of that theoretical background, we can make exact, specific forecasts. But what we can do is I liken it to a meteorologist. We're talking here in the year July 2013. It's very likely it'll probably snow in the Northeast in January and February of 2015, but we can't give a specific date on when it will snow today, or meteorologists can't, because basically there's too many factors involved to give the specifics. But what the meteorologist does have is he has a framework of seasons and how much light a geographic area gets during a certain part of the year, and when snow might occur. So he can make some kinds of forecasts, but he can't make others. He can't say, it's going to snow on February 20th, 2015, but he can say if it's going to snow, it's likely to snow in January, February, or months surrounding that, because of the framework that I understand about seasons, and it's very, very unlikely to snow in the Northeast in July or August because of that same framework. So the meteorologist knows some things, but he doesn't know exact things. Same thing with an economist. If there's a period when there's a lot of money being printed, that I would call a season where there's the potential for inflation, although you can't predict an exact number, and it may not happen because of very, very complex factors involved with all the human actions. But that's sort of a season where inflation could occur. And then if there's a period where there's tight money and it's not being increased, maybe even being decreased, it's a very unlikely period to have inflation. So we can, as Austrians, we can see sort of general patterns and know what's going on and what could happen at different times. But we don't try to be the econometricians. We try to make these false constants and parameters and say, well, something can't happen between this this number and that number. You can't do that in economics any more than the meteorologist can make a specific forecast for snow on February 18th, 2015 right now.
And that's a good analogy right there, using the weather and comparing it to the economy. But yeah, I agree. The economy is so complex. There's so many factors that changes every day. It's so hard to predict what's going to happen. And using mathematical formulas and models is just that doesn't work that way. That's why Austrian economics are a lot better at forecasting what's going to happen.
Yeah, and I'll tell you the best example that Mises uses as far as understanding that you can't know everything and everything is too complex. He starts with the basic theory, okay, man acts. What that means is that man believes the future is not completely knowable. Because if a man knew everything, he wouldn't act. There would be no reason to act. Because if he knows exactly what's going to happen, why would you act? Why would you act? It's going to happen anyways. So, right from the start, Mises, has these econometricians right by the neck. I mean, the econometrician can't argue with that, and there just aren't the constants in human action. Not everything is knowable, and because of that, the equations can't work. To the degree things are complex and changing, the more you're going to have a situation where an econometrician is going to have some kind of constant which he's going to have to assume in order to create the equation, because you need a constant to create the equation, and they blow up on them. And given the erratic economy and things that are occurring these days, there are more and more of these false constants that the econometricians are working with that will blow up in their faces and cause tremendous losses and wild swings in the markets.
And that's a great point. And the next question or subject I want to talk to you about is the ongoing debate between inflation and deflation. Now, there's a lot of people saying there's the deflation in the economy, and there's a lot of people saying there's inflation in the economy. I mean, there's also people out there that are saying that both inflation and deflation that's going on in the economy, where we have certain assets that are in a bubble while other assets and capitals are deflating in prices. So I wanted to ask you, what's your opinion on the inflation versus deflation debate? Do you think we have both going on right now in this country?
Well, I don't really see much in terms of deflation. There's people like Paul Krugman that are continually harping on that and warning about deflation. But if you look at the Fed supposedly has a target inflation ceiling of 2%, and the number I look at most closely as far as a price inflation indicator is the MIT Billion Prices Index, where they go out and they're measuring in real time every day, maybe hourly. I don't know exactly how that works as far as the time factor, but it's at least daily. So they're measuring about billion prices every day off the internet. So they get a broad spectrum of what's going on with prices in the United States, and that number right now is growing at 2.5%. So we're above the inflation target that the Fed has supposedly set. That said, there are some sectors of the economy where prices are going up quicker than others. The areas where they are going up the quickest right now is the stock market, again, the real estate market, and that's explained by Austrian business cycle theory, where we say when the Federal Reserve pumps money and the banks create the money, the Federal Reserve pumps the money and then the banks loan it out, that money tends to go into the capital goods sector first, which includes the stock market and the housing market. So those are the strongest markets, and it's completely understandable in terms of Austrian economic theory. Then what happens is that money works its way through the economy, and you start to see it having impact on consumer prices, which is where we're at now. It's just sort of starting develop in that area, and I expect that to grow in the future as more of the money works its way through the economy. So there's really sort of an overall price inflation. Now there are certain sectors where prices are dropping, but those are special situations that are very high productivity areas where the productivity is increasing very, very quickly. And that can be flat screen TVs, laptop computers, smartphones. What's going on there? There's dramatic changes in technology which are enabling greater productivity and pushing those prices a lot lower. They also happen to be three sectors where there's very little regulation, so they're not slowed by regulation. So if we actually had an economy with a lot less regulation overall, you would probably see, even despite Fed money printing at the rate it is, a lot more areas where prices will be dropping. In the more of a long-term situation, I watch the Federal Reserve numbers. I report them in the EPJ Daily Alert weekly, and make my perspective or create my perspective on the inflation ahead based on how much the Fed is printing and what's going on with people's desires to hold cash balance and a few other factors. But what I see happening now is an increase in the inflation because it is working its way through the economy from the capital goods sector to the consumer goods sector. And as I expect interest rates continue to rise and the Treasury will be required to raise even more money, and the Fed buys a lot of that, I could see price inflation heating up substantially down the road. That's a year or two down the road.
And the funny thing is that a lot of the mainstream economists and politicians they hate deflation. They think it's the worst thing for the economy. When in the Austrian economic world, we think deflation is a cure for the diseases that we have going on in this economy. That's something that we need right now in order to get the economy going, because with deflation, asset and capital become cheaper, so standard of living is a lot better, and people can save as well. It's an incentive to save. When you save, it creates capital and jobs.
Right, exactly. And, I'd like to see some of these guys come out for higher flat TVs prices, higher laptop prices, and smartphone prices. It's ridiculous. It makes no sense at all. And then the other argument is, well, how could businesses survive if prices are dropping all the time? And you look at some of the most thriving companies, ones in these areas where prices are falling. Apple Computer, Google, all these companies in the non-regulated area where prices are falling, they're the ones that are thriving. So that argument doesn't work either.
Yeah, and one of the few sectors in our economy that has free market is technology, and you can see the true market forces and what's going on in there. And unfortunately, we don't have that in other sector in our economy.
Right, exactly. Yeah, everything else is very, very heavily regulated, and for the average person out there that isn't really studying and thinking about these things on a regular basis, it's hard for them to conceive of how things could operate without the government there. But once you understand the framework and you see where it's working in the technology area, it becomes much easier to understand how it would in other sectors. I can remember in the old days talking about the post office and how that should be turned over to private sector, and this was before FedEx and UPS and all that kind of stuff. And it was much more difficult for people to conceive of a private company being able to deliver mail or packages or anything like that. And then suddenly, with the birth of Federal Express, it's sort of a little bit easier, anyways, to get people to understand that private sector can't even deliver the mail. So,
and that's a great point. And if the postal service was privatized, we wouldn't have Saturday mail by now, and also door-to-door delivery would be gone. But those two things are still happening, mainly because the postal service have to do this in union, and anytime they try to cut something, they hear it from the union.
Right. What's interesting is I spend about half my time in Washington D.C. and half in San Francisco, which are both areas where there's a lot of support for interventionism in the economy and deals with the government. And here in San Francisco, I like to talk a lot about the crony left, and of course I'm saying this to leftists because they're all leftists out here, and they seem shocked by that. I mean, they can get crony capitalists, they can get the sort of the corporate guys that are cronies, but they don't seem to be able to register. It's the first time they've ever heard it, that there's such a thing as a crony left. And the post office the post office union, which is has enormous lobbying pressure to keep them alive, is something that they don't think about. But there's a lot of that too. Obamacare is sort of crony leftist.
And that's a great point there. And also in San Francisco, they're in the middle of a strike with the public transportation. I don't know. I forgot the name of the public transportation.
BART is actually. It's
right.
Yeah.
And
they actually.
Go ahead.
Yeah, they actually put that on hold for the time being. They're back working at their $150,000 jobs for a while.
Yeah, I hear bus drivers making six figures over there.
They make a lot of money.
Yes, the same problem here in D.C. with the mass public transportation service that we have here. A lot of bus drivers making six figures, way too much for someone to drive a bus around. So anyway, I have one last question, and that's regarding entrepreneurship in this country. Now, despite what's going on in the economy, we're still seeing entrepreneurs innovate and create jobs. We have people like Elon Musk with his Tesla Motors, which is a high-end electric cars, very nice cars. He also coming out with other ideas as well. We have Google still, producing innovative products, and Apple as well. Do you think entrepreneurship here in this country it will be enough to save our economy, or you don't think that it will be enough? We need other factors to improve as well.
Well, Mo, I think that's a very, very good question. It's not clear to me if there is enough entrepreneurial ability within the masses to really see it take over and sort of rule versus government regulation and stuff like that. The first problem, of course, is the regulation itself. It suffocates. It makes it very, very difficult for an entrepreneur to start out. It makes it very, very difficult for an entrepreneur to raise cash. It's just a very, very difficult situation. But on top of that, I'm concerned about the general understanding of what entrepreneurship is and how, in many ways, it's easy to go out there and make money if you understand how to look for opportunities. But you don't get any schooling on that at any level. You don't get it in high school. You don't get it in college. You don't get it in the MBA programs. You just don't get a sense for what real entrepreneurship is. And a lot of that has to do with the fact that I think teachers, because most of them come up through the government system, or either teaching in public schools or universities, or at least private universities that are heavily influenced by the government education program. All these people have never had a job outside the school system in their life. They have no clue as to what it takes to be an entrepreneur. And consequently, they don't understand entrepreneurship, and that sense of what an entrepreneur is not getting out to the majority of people that are going through the educational system. If you look at the guys that have been most successful in entrepreneurship, it's guys that have dropped out of college. Mark Zuckerberg, Bill Gates, Steve Jobs. These guys sort of had it in them already. And to the degree these people are out there, that's great, and it's really important, and it can help sort of find the loopholes in the system where products and businesses can be developed that can sort of push government regulation and not make it as interventionist in impacting the majority of people. But I just don't know how many of those people are out there, and the education system has a lot to do with it. If more people understood what entrepreneurship was about, this would be a much better country, and we'd be able to blow away a lot of these regulations by just clever entrepreneurs figuring out ways around them.
I definitely agree with you there. So, Bob, thank you for coming on Wall Street from Main Street podcast. If people want to find out more about your work, where can they go?
Sure, you can go to economicpolicyjournal.com. Actually, if you Google EPJ, probably the second or third link will be to economicpolicyjournal.com, so that's a quick way to get to it. And all my work is up there, and you'll be able to find direction to everything else, including the EPJ Daily Alert from the Economic Policy site. So, Mo, thanks you very much. It's been a pleasure being on your show, and great questions.
Thank you, Bob, and hopefully you can come back in the future.
Sure.